All right, markets are open and things are getting crazy. So let's take a look at these cycles, and we'll do some technical analysis and do some cycle analysis and see what we can get here. So I guess let's start out. If you're new on the channel, this is a cyclical macroeconomics channel, and I do the technical analysis inside of macro cycles. So what we have here is a macro cycle that is about 3 to 4 months here. And we have our drawdown, and you usually get a bounce and a couple bounce shapes in this kind of cycle. This is a credit contraction cycle that looks like it's a bear market credit contraction cycle. And this is backed up by a bunch of financial data. And so we're just kind of tracking this shape, and we're getting the very interesting thing that we're getting repeated patterns throughout this cycle where we break a major trend line and backtest it, and then we get up and test it a couple times, and then we break another trend line and backtest it, and then we get up and we test it, and it looks like this kind of double test here is looking like this kind of double test here. And we just got today our first major downward sell-off since before we crossed over our tangent line here. So we have these kind of bear trap shapes here across our bull line. And if we go back to the previous cycle, let's take a look at the previous cycle and see what we got. So we're looking for these kind of shapes to repeat on each time level. This is kind of on the weekly level, so we're looking for this to repeat on the monthly level. And so we get one big bear trap shape here that leads into that second reversal point. And I think that might be where we are on this cycle now. And then maybe that's a steep bear trap shape up here, and can't really see in here. But you can see that we cross over the tangent line, and we get a couple action spots here. Then we get our big bear trap shape into a reversal. And then once we start coming down, you get sharp down movements, and then you get fighting up movements, sharp down, fight up, sharp down, fight up. So that's the bear side shape here. And let's get out and do the Elliott waves. So for the Elliott, we get a pretty clear corrective wave here, which is an ABC corrective wave down off the top of the everything bubble. And this wave is complicated. And I mean, here on the way down, we get these back tests, and we get this consolidation zone 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. And I'm wondering if this is what the consolidation zone looks like on the way up here. And I was saying this was a 5 wave, but now it's looking like a 7 wave or something that's more complicated along Elliott wave analysis. And I have to get in here into the subwaves and take a look at that. I'll do that in another video. So on this credit contraction cycle, we're really looking for kind of a turnover and another down move. And in the technical analysis, we have here the decreasing volume to here, and now volume's kicked up with this move down. So this could be sort of the end of this kind of volume decrease. So if we start seeing volume increase and we start seeing volatility increase, that'll be downward pointing signals. And this really aggressive down shape and this fighting up shape here is a big signal. And then let's look at these long-term trend lines. This is looking bearish, and we have these trend lines. So this line goes back to the 2018 bottom here. And this is a tangent line that starts from the bottom of the 2018 bubble, and it's a bull market support tangent line for this whole wave. It's like a 2-year long wave, and that wave terminates right here on this second hit, and then we get down to the next lower support level, and this one is on the 2008 financial crisis bottom. So that's like a 12-year wave that has this yellow line as a support. And so on the cycle model, sort of the backside of a bubble, while you're testing these waves and terminating them on the way down on the backside of a bubble, which is a bear market, just the backside of a bubble, which is what this looks like. We may be getting this kind of second test here and testing this line. And I've been wiggling this line around a little bit. It's a 12-year long line, so the tiniest little wiggles and where you place this line make a huge difference. And this is one spot that looks really good to place it. And right here where we just bounced looks really good too, because you get this action on top and this whole crossover pattern. And then it kind of chops the two peaks up. So you get these two peaks above, W below. So it goes peak, W peak here across that line. And then we get this big back test here, which is good. And so we're in this zone here, and we are looking at, so this tangent down off the top of the cycle. I'll show you a couple other tangents and see what these things are. So kind of on the small scale cycle here, we have a tangent line that is where we crossed over from a bear trend over onto a bull trap line here. And then we get this tangent here, which is chopping our current, which looks like a bull trap as well, where we crossed over into the bull trap. And this, we have kind of two different bull support lines. We have one to the first peak and one to the second peak here. And that works on the previous cycle end here. And then my favorite way to draw bull support lines is you get these bear trap W shapes, like these guys. And those tell you exactly where your bull support line is. So you chop the peaks off of the bull trap W's and you get the line running through where the top of the W is on top of the line. And that's how I place my bull support tangent lines. And it looks like we terminated this lower one right here. So I don't expect to get back there now. That looks like it, like we did this W shape. But this is a bull target here to get back above this yellow area and back around this green area. That's where the bulls want to get. And the bears right now are looking to back test this yellow area here, which we already got a back test, and we're kind of in this zone. So we could see a little bit of action in here, and then maybe if we get under it, back test this one again. And that's kind of the bearish action. And then after that, there's not really much, there's really nothing supporting this thing. And the next actual tangent line under this one is way down here. It's around like 1200 or something, and that's the 40-year long tangent line. That is the whole everything bubble tangent line, and the entire everything bubble is a bull side wave from this 1982 bottom, which is a mean reverted bottom where the everything bubble started. And so this is kind of a target to unwind the entire everything bubble. That's more of a target for 2 years or 3 years away, probably. Like if you look at most of the bubbles, .com, the Nikkei bubble, Great Depression, housing bubble, Black Monday. Well, Black Monday was quick, but it's a tiny one. Most of them take 2 or 3 years to wind all the way down off the bubble. And all we have here is our first credit contraction cycle off the top of the bubble. So you don't just do a 1 month dart all the way down off the entire bubble in like a 3 month cycle. So I'm not exactly sure where to put targets on the S&P, but I know if I look at the NASDAQ, the bubble lines are different, and I do have intermediate targets that are more clear on the NASDAQ. And so that's a good way to compare kind of intermediate targets. But let's look at the MACD and check out. This is a pretty intense trading area, and we're seeing the volatility kick that's a big bear signal. That volatility kick is a big bear, or the volume kick, and we're seeing the volatility kick really hard too. I'm not going to pull up the VIX right now, but the volume and the volatility kicking is a big bear signal. And here on the immediate day trading, we're down here in bear territory now on the daily, and this switched, and if we get a turnover, and if just basically any action down on underneath this line is going to be bearish. And so the bulls want to get back up here onto the bull side of the line, and the bears want to stay down on this side and do activity down here. And that's for like the 1 to 2 day kind of trading range. It looks bearish, but it's headed up, but it doesn't look like it's staying up. It's kind of flattening out. So that looks really bearish for today, for the rest of the day today. And I guess the targets would be try to catch that peak. I don't know. Maybe we get another back test of this yellow line at this red line peak here, and that would be a really good place to short if it can get back up there today, or wherever it turns over. I don't know. It might stick around this red line and turn over. But if this pushes up more, it should be pushing up near this yellow line again. And that is a huge resistance line, and it looks like it would be turning over on the daily, like midday today, and that's whatever this is, around the same peak as the other one at 2882 or something like that. And this is not investment advice, just going over some technicals and things like that. And please hit the like button to help me out with the YouTube algorithm. And I'm going to switch into the daily MACD and get a longer outlook here. All right, so this is the daily MACD here with the daily candles is going to give us more of a view that can show us kind of where we are in this credit contraction cycle and how it's looking. And what we're getting right now is super bearish also. Okay, so this MACD crossover means that bullish momentum has kind of shifted, and we get volume down, and then we get our first bear side candle on the momentum crossover. So this is bearish kind of for the next month or so. But it doesn't mean that it will be bearish for the next month. It's just on the monthly cycle, it's turning in the bearish direction, but we're still way up here in bull territory as far as where the lines are. So if we get a kind of a high bounce above this line or anything like that, that's very bullish. And so the bulls want to stay up here, and the bears are looking to cross over and get down onto the bear side down here, and then any action here would be bearish. So this is not bearish right now. It's on the bull side, but it crossed over, and that indicates a downward movement, which should be a short-term bearish movement in a bull month range. And if it does cross over to the bear side, then it gets very bearish. So I guess on shorting, basically by looking at these two, it looks like shorts are good on the weekly, and they are dangerous on the monthly. And the thing to watch out for on the MACD is a bounce here. And if it bounces above this bull line here, or above the zero line, this is going to be really bullish. And if this kind of bounce happens, like, I would close all of my short positions out and try to make any money there. And then the upward movement would just be straight long for short term. So that's kind of the look for the bulls and the bears. We are still bearish. We are still bullish here on the monthly outlook, and it's turning down. And so we don't know where it's going to go. And this is just absolutely nuts. Like, the momentum swings are just these little things prior, and we were, mostly bullish the whole run up to this crash here. This was a bunch of bull activity, and this is a huge bear rip, and it managed to get all the way back on the bull side straight out of that rip, which is pretty wild. Like, you almost never see that in a credit contraction cycle. Credit contraction cycles almost always stay on the bear side until you get out of the cycle. And so this is a absolutely crazy cycle that's very hard to predict. And this is not what I was expecting. I thought that we would get this thing to turn over on the bear side down here and get a pretty clear move down. And it's not a clear move down right now, but it looks like a short-term move down this week, just based on all of these MACD fundamentals. And I can jump out to the weekly, and this is kind of like a look at the year. So on the yearly range, we are mad bearish right now, and we're about to cross over. So this means like this kind of month or two here is a bearish month, and it's about to cross over, and we're about to go positive here on this side. So it's going to be bearish down here until we get these lines over to the bull side. And so over the next couple of months, we'll see if this gets positive or if it starts crossing. That would be a really bullish signal that could be out a month or two from now. And that's just kind of towards the end of the year, sort of what the outlook might look like on the long term. But we are super bearish still right now. This rip down just destroyed like a whole year of bull activity on the long scale. And it's going to need a lot of bull movement to get back up here. But you can see this thing is kind of bottoming out and about to cross over. So that is kind of the trends. And this is a good sort of leading indicator for what we might be looking at a month from now. And the dailies, we did the dailies already, I think. The hourlies, let's just get back in the tiny ones and see what we have here right now. Yeah, so this is still working its way up, and it's not about to cross over right now. So this looks like a bull kind of run for today. Back up off of this peak here, or this bottom candle wick that we got across the red line. So I'm going to be looking for a spot to short today, and I will be looking for probably this resistance line right here. I think that makes the most sense. This yellow line, and we'll see on the short-term MACD if we can get the short-term MACD to turn over and get this thing to go back red. And then we're way down here in bear territory for the rest of the day or 2 days or so. And so if we reverse off of this thing and get a bear side turnover and a bear side momentum swing and a reversal off a super major trend line here, then that could be a really bearish shot down on the day to 2 day kind of thing. So I'm going to be day trading this, and I guess I can tell you what I'm looking at for the day trading ideas that I'm doing right now. I've been looking at the XLK a lot as a short, and those tech companies are up. They're just up too high, and there's a lot of room for those to come down. Oil is tricky. So, I mean, the oil prices are rising, but they're still low, and this credit contraction can definitely pull the oil companies down at the same time that the prices are rising. So it's kind of conflicting signals. I just think, I don't know. Oil is just really tricky right now, and the tanker stocks have really good fundamentals in these market conditions over the next month for sure, but probably the next 2 months, maybe the next year. And this kind of downturn, this is a credit cycle contraction down in the market that's going to be pulling everything down. If we get this S&P full market contraction pull down, then that's going to pull all kinds of stuff down. So there's a lot of stocks that seem really safe, like PayPal or something in the XLK, that could get pulled down really far. They're just up too high right now. And those are the kind of stocks to look for. But it seems like shorting the ETFs has been doing better than shorting individual stocks so far. And that's just the way that derivatives and futures are built into the ETFs, where the actual ETF can be worth less than the underlying assets. And I've done some videos on contango and on sort of the compounding effects inside of some of these ETFs. Um, but you kind of just get a little bonus shorting the ETFs just the way that they're financially structured. You just get like little percentage bonuses on all the volatility, and yeah, and it's possible for the ETF to be worth less than the underlying assets. So that seems to be a good strategy in this cycle where the ETFs are overvalued even more than the individual stocks are overvalued. And so the industrials like QQQ, the Nasdaq, Tesla, those kind of things, those things are up. They're really high, so there's a lot of downside, but they seem to be on their own different trajectory. Um, so it's harder to point at the shape and the downside of those than the stocks that are actually following this S&P lines, because like the Nasdaq is up here, like interacting around this line still. And so a downward target for the Nasdaq would be to come down off of this line down to here, I guess. And that's on a different chart. I've done a couple Nasdaq charts, but it's a more clear actual target pattern to short the Nasdaq, and those stocks are in their own little world right now. And oil is in its opposite own little world, crashed way down below everything else right now. So those are difficult. But tech is here in this middle zone, and there's a lot of things here, like the Russell 2000 is a really good set of stocks that probably won't get bailed out and most likely are going to get into credit trouble and a contraction here. So, I mean, we could get a contraction that pulls down for a few weeks here, and that could just be destroying the Russell or uh, the foreign markets, the emerging market funds. And this is a worldwide monetary contraction, so those emerging market funds could really rip down too. As far as stocks, like entire funds that could get in a lot of trouble and have very small percentage chance of a bailout, it's those emerging market funds in the Russell 2000 that could really get in trouble over the next month and a half, maybe, as this cycle kind of plays out, and those companies just get in trouble and don't get help. Um, so I'm looking at some longer term, maybe shorts on that kind of thing on the Russell 2000 and on the emerging markets. And then there's all kinds of fun little tricky plays in here. On volatility, volatility is kicking up right now. And basically, if you go long on the VIX or the TVIX or something, you're losing percentages to all of those compounding and all the contango. The structure of the ETF or the ETN is fighting against you when you go long on the TVIX or the VIX. But there's an inverse VIX, and I forget the symbol for it. I'll take a look at it in another video. But if you short the inverse of the VIX, then you get all the compounding math and everything on your side. So you short the short VIX, and I think it's SXIV or SV. I can't remember, SVIX or something like that. Um, so that's the first short that I actually bought today. Is I shorted the inverse, and I can't remember the symbol. And the inverse VIX chart looks something like this. But you get like all the downside on those compound products, and the upside gets capped. So that's a good long-term short on the TVIX, or I'm sorry, on the shorting the inverse VIX. Is way more mathematically effective than going long on the VIX or the TVIX. And that's what I just did here. And I'm going to have to get out of here and start trading if we're going to get up here and test this line. I'm not going to be talking to you guys. I'm going to be in my account doing some interesting stuff. So let me mention a couple other things. The industrials, the energy, and the tech are the three sectors that do really well in general, but do really poorly in these credit contraction cycles. And they have been wildly different. Like the industrials are to the sky, the oil's on the floor, and the tech's right in the middle. Um, so, so I guess tech and industrials have the most room to fall, but I mean, who knows with the oil? I mean, a small dollar price change in the oil could be a big swing in those ETS percentage wise. So I think these are all interesting shorts, and they're dangerous if we get a bull side bounce. So these are not long-term short positions. These are short right now on resistance, and then we just got to see if we stay bullish or if we switch to bearish. And if it goes to bearish, then those will all be incredibly good shorts. And if it stays bullish, close all those things and take a look at going long on like oil tankers and gold and stuff like that if things go positive. So this is a really critical and tricky kind of day trading area right here, and we may very well be we may have just fallen off the edge of a cliff here. And as soon as we break these lines, there's nothing below here supporting any of this stuff. And I'm out of lines. I'm gonna have to come back and make up some fake lines for support, like these kind of gray ones that are just sort of reaction lines. We kind of have this reaction line down here off the Black Monday, but this is not a wave tangent line. This is just kind of a reaction line. And there's some areas in here, like on the last wave pattern, we kind of got a dead cat bounce off of the bottom of this two wave here. So like maybe this area might be an area to look at. I can come in here and put some fake lines in here later as sort of ish bouncing kind of areas, but yeah, just really have to watch the MACD on the cycle here and see if it looks like it's going to reverse in bull territory or if it's going to cross into bear territory. And if it crosses into bear territory, this is a rip like for the next month or something. So we might get a bull bounce in like 2 weeks and stay up here around this trend line, or we might get a bull side switch or a bear side switch over and just rip down into uncharted waters down here. So that's the short outlook. It's very, very short, very bearish today, and across a ton of different stocks and different sectors. They all look super bearish this whole week, this whole weekend, this whole week. The volumes are down. All the chart patterns are giving bear flags, like double tops, parabolic reversals, or just these ascending kind of trend patterns where you just get like a weaker and weaker and weaker up wave, and it's just kind of dying at the top. So these are all bearish across all the sectors. And yeah, I guess we could talk about some specific stocks. I mean, I'm really looking at shorting ETFs mostly on this move down, just because they seem like they could get in a lot of trouble here. But I think like inside the tech XLK, it looks like PayPal is the one that is up way too high inside the tech XLK, and that could get pulled down with the group as sort of a largest area to fall kind of stock right now. And then Dell is the worst balance sheet in the tech XLK, so I like shorting Dell on the balance sheet, and that would be a longer term short and see if they can get in trouble over the next 2 months or something like that. But PayPal could be a more kind of targeted reversal short on sort of day trading kind of activity. It could get some big moves in the short term. And then, oh man, Tesla. Oh, Tesla. Tesla's in the NASDAQ, and the NASDAQ is flying high, and the NASDAQ is up here around this trend line. And Tesla's up here. Tesla's in its own little bubble world over there. And Elon Musk is breaking the law, opening the factory. He's fighting. He's selling all of his houses by owner. He's tweeting that everyone needs to go back to work. And he went and opened the shop today, and he's posted a message that said, if you want to come to my factory and arrest people for working, just arrest me and don't arrest my employees. And Trump came on and talked to Elon Musk on Twitter and said, let him open his factory. And Elon said thank you to him. So this is crazy drama with the factory. Elon threatened to take his factory completely out of California and close the headquarters in California and open the headquarters in like Texas or Nevada. So my goodness, like Tesla is nutty, and I really like to use Tesla as a market indicator on sort of market reversals because it gets those hypey movements that you can kind of see, like Tesla's doing a, like a parabolic kind of thing. That's an important area to watch out for. So, um, so yeah, so Tesla and the industrials have plenty of room to come down, and they haven't wanted to come down yet. So that's an interesting one to watch. I don't think I'm going to try to short those right now. Where are we now? Not quite up there yet. Okay. Yeah, so we're still kind of wobbling, still trying to get up here. So this is good. This is good for this line here, and it's not going up at a really sharp angle. It's just trying to work its way up, and it's getting wobbly. So I'm expecting a big reversal off this area here, right here, 2882. That's kind of my target for shorting right now, and I just got my funds that took a freaking month to move over here cleared, and I missed shorting these peaks. So I'm going to try to short this resistance line. And I guess that's probably a pretty good market overview on the cycles and the technicals, and just sort of the double top in a bear market. This double top, that's the opposite of these kind of W's. You get these W's underneath your bull market lines. Those are bear traps. And on bull market lines, and the lines are pretty much always bull market lines. You're either building the bull market line or you're reversing and terminating it on the way down. But these double tops, people call them M, like M for murder. And when you terminate tangents with a double top like that, and that's what we've been getting here, and that's what we saw a lot on the Nikkei, is these double top murder reversals off of these major trend lines. And you get them over and over. All throughout the Nikkei reversals and all throughout this cycle, we've been getting these double top M murder reversals. And maybe we got one here. And if it does, and if it reverses hard off this trend line and rips down, then the indicators are all going to get really interesting. And that volatility is going to blow up again. So that's why I shorted the inverse VIX, which is the same thing as going long on the VIX. It's long volatility, but it is a mathematically effective way to go long volatility where the actual compounding is in your favor. And I can do a video on that, but nobody knows how to search for that keyword. So I'll probably do like a TVIX or VIX video or something and talk about that other one. And man, yeah, I was talking to the guy at capital.com yesterday, and just trying to ask him how to go long on oil in this situation. And he's just like, I don't know. Like, I was asking him about the ETFs, and he's like, yeah, the compounding is not in your favor on the UCO and the USO. Like, going long on those is just like, you're just kind of shooting yourself in the foot. He's like, you can just trade the spot price of oil if you have a target. And I'm like, yeah, but the target's only going to go up another $10 over like a month and a half or something. Like, that's kind of boring. So I still think these oil tankers are the best way to go long oil. And I think that this credit contraction cycle is going to pull those things down right along with everything else. And it's really just looking for entry points for longs on like oil moves and gold moves. And then of course, the longer, oh no, I moved my fake little support line. Okay, so at the end of this cycle, which looks like it's going to be in June sometime, maybe in this, I don't know the price range, but the time range here, like sometime beginning of June, looks like it's going to be the kind of reversal. And we'll look for a big consolidation pattern. And then we can get a reversal into different market conditions. And that's where you go long on the oil companies like Exxon or BP, Shell, like Mobil, those oil energy companies. When you get a market reversal and rising oil prices, that stuff's all going to get super bullish here. Or like GE, or like I love like Tesla, and I love the XLK and all the tech stuff. Once you reverse out of here, Shopify, like those are all going to be killer longs after this cycle. right now everything is just crazy, crazy dangerous, and shorting is dangerous because we're on the bull side of the MACD, and going long is idiotic right now. It's just so dangerous because the downside, I mean, basically the upside for a long move here is just kind of hang out in this area. There's just not that much upside. Or even like a bullish move would be a move down and then get back over to here. So just the upside is just really tiny right now on longs, and the downside is literally like this. And just the asymmetry is very bearish, just probability wise. And and then of course, like if you're doing options, like I like to do some put options on these kind of vertical movements because you can really make money on the downs. But those are risky because if you get sideways movements on your puts, those just kill your timeline and you can lose all your money without anything really happening. Um, and that is why you really, really need to time put options to get down. Like you need to buy them when they're going down, like right now. Put options need to go down immediately. And so that's kind of basic put option strategy, and shorting maybe the XLK, emerging markets, shorting the Russell. And I can do some more. Well, I don't know. When I do I mean, you can just look up the ETFs, like look up the Spider, the most popular ETF for, emerging markets and Russell and those kind of things. I can't remember the exact ticker symbols for all the ETFs. Um, but I've been checking the charts, and they're all looking like good shorts coming up here, and they're not all following this exact trend pattern, but this will give an idea of when the entire credit contraction cycle is reversing, because this S&P is tracking the credit cycle really well, and that credit cycle is going to affect everything. And stocks that are going to fight against that contraction might be like in the healthcare kind of industry, or consumer staples things, kind of like Walmart or McDonald's or something like that is going to be fighting against the contraction, because those do really well in these kind of cycles. But really well means down a little instead of down a lot on the down moves. So it's not something that I would go long on for sure. And there's really nothing I would go long on probably at the moment, except maybe take a look at treasuries or DXY. There's some kind of dollar market plays that are interesting longs right now. I haven't looked at the DXY in a week. I might, if the DXY is on a downswing, I might go long on DXY. I was just kind of like a dollar play with a slight upside. Um, okay, so that's the cycle, and kind of the sectors that get in trouble in this kind of cycle, and really, really, really a interesting area to short things right here. And how are we doing? Just kind of, it looks like it's kind of dying. Okay, so I'm just going to be watching this and trying to day trade this. But when I say day trade, I mean I'm going to be getting like 1 or 2 month put options and maybe day trading those and maybe holding on to them and seeing kind of how it goes. Because I like the general idea with the put option, if we get another month in this credit contraction cycle, that means you probably want a 2 or 3 month put option where all the down activity that you're expecting happens in the first third or the first half of your put option. And that way you can sell the option back and get your insurance money basically back and get the spread. Because if you're getting down towards the end of your put option timeline, you're losing money on the time value. Some basic put option stuff. You can look up some put option strategies in my playlists. And I think that's about it. Hopefully my subscribe button thing is over here somewhere. And please help me out with the like button and start up a chat, a conversation in the comments. That's the best thing that really helps the channel more than the like button. And I don't know if I have anything else to add here. I don't think so. This is quite a thing, and this is a major bull market thing. Yeah, so As far as this trend line sort of looking like this trend line, I mean, it's quite possible that we get sort of a high bottom and a retest of this trend line. But on the market cycle data, like especially from Hedgeye and things like that, it's showing that we're going to be switching into a credit expansion in the next quarter, which is vague exactly as to when that would switch over. But it doesn't leave a whole lot of time for a high bottom bounce. And sort of if you did like this double move that's high here, kind of intermediate bottom and get back up. I don't know if there would be time to have another down move as far as the credit contraction. I think that we'd just be on this trend line for the rest of the year or something like that. Um, so the high bottom bounce is one look, and then the sort of dead cat bounce rip is another look. And I think those are the two most probable things to look out for here. And it's all about the MACD on the dailies if we get the high bounce or if we get a crossover. And that's the look. And this is crazy markets, and this bull trap has really, really been a bull trap here. And people are in this thing and people are excited about the whole stock market, even with this insanity and this crazy high volatility that is just nutty bearish. This credit contraction cycle with high volatility is just awful, awful for investments, long-term investments. And just the structure of reversing down off of a bubble indicates like a couple year long bear market to look out for, and a credit contraction cycle right now in a long-term bear market is what we're looking at in the bubble model. And so I am very, very bearish on three levels, like on the hourly and on the yearly, and then for the next month, I guess, for this credit contraction cycle to play out. Um, but when this credit contraction cycle reverses, you're going to see me being crazy, crazy bullish when everyone else is like, oh, the stock market's garbage and everyone needs to get out and all that. Like, we're going to get this consolidation area, and I'm going to be like bullish as crap about all these stocks that are terrible that everybody hates. And I'll get some more haters in about a month or so. But we'll see if this bear move is actually a bear move or if we get a high bounce. That's what we're looking for. And thank you. Thank you very much. Happy trading.